We're privileged to have the three gentlemen here who have all built terrific businesses over the last number of years. And what I'm going to do first up, gentlemen, is try and get the lay of the land of where you all stand. And in our how to survive and prosper markets get bumpy, let's start with the word bumpy, and then we'll go back to prosper and survive. And we'll have a funnel conversation. We'll take it wide and then we'll narrow it right down about how we do it. So, are we in a correction? Let's just give the backdrop before I stop talking. The US market hit a high on January 26. From top to bottom, if we take out last night, it got down about 12%, which is officially correction territory, 10%. Japan's down around 13%. The European markets, the big ones, the DAX in Germany and the FTSE in the UK, both over double digits. Australia outperforming, down about 5.5%, and believe it or not, the Kiwis are actually up in that period. I'm not sure about that, and we wouldn't include them as one of the big important markets, but anyway, that's a fact. So, are we just in a correction or the start of a bear market? Let's see the lay of the land. Phil, you go first. What's your call?
Look, I think I just see it as a healthy correction. Like, it certainly hasn't been a great bull market for Australia. You know, it depends whether you're an optimist or a pessimist. You can look back 10 years and say, oh, stock prices have been rising for 10 years. You can look back 10 years and say stock prices are below where they were 10 years ago. So I think it depends on how you look at things. I think to be a good equity investor, you've got to be a little bit of an optimist. And so I certainly don't see this as the start of anything too bad. All
right, let's over there. Stephen, you concentrate on the Aussie market, small to mid caps. They've even outperformed the big guys in the last couple of months. Is it a correction? Or are we heading into a bear market?
Yeah, I'll probably more side on what Phil just commented there. I think it's actually a healthy correction. You know, the last year and a half, we didn't have a month that was down. It was abnormally low volatility during that period. So I think we're just, you know, as yields back up and as interest rates increase, it's just a bit more of a reversion back to the normal. So I think it's a healthy correction. I think we'll have more volatility, but I don't believe it's the start of a bear market. Okay, so we've got two bulls there. Hamish, I get the feeling you might, with your global perspective, might think it's a little bit more bearish than that.
Yeah, well, I wouldn't view that what we've seen in the last few months is a correction. You know, I think things are just backed off a little bit. We're near all-time record prices at the moment. So if you call that a correction, you haven't seen anything yet. We're in the most conservative position we've been since September through March 08 to March 09. So we've got the most cash we've held since then. We think the risks are asymmetric to the downside at the moment for a whole series of reasons that we just taught Brett take us through. And I think it was almost word for word what I wrote maybe 2 or 3 weeks or so ago. Maybe I had telepathic views of what he was saying. And the reason is I do think it's fairly evenly balanced at the moment. I think the sort of Goldilocks environment continuing, where we get very well telegraphed rate increases with inflation not coming, I think we're in a fairly benign place, and that's pretty easy for equity investors. You just work out that you don't want to be in super bond-like equities. You stay very underweight them. We've been underweight those for the last few years. We called the sort of rate cycle back in 15, it's sort of benign one, then 16 with the China shake. It went off, now we're back in that cycle. I think that's pretty easy to navigate, and it's just being in the right place in the market, and I think you can still make real money in that Goldilocks environment. But if the Fed gets behind the curve here, and we do get inflation, particularly in wages in the United States, I think people should be penciling in at least a 20 to 30% correction in all markets around the world, because I think the back end of that yield curve will move and could move pretty sharply. So if you're looking at it as 50-50, and that's a very polite way of saying I don't know.
Okay. Because I was going to say you're not going to get away with it. The other two have told us the correction.
But if you look at the odds, if you look what Brett was saying, he goes, in a Goldilocks environment, maybe he's looking 5, he was being at 10% per year, but let's say it's 5% per year in the Goldilocks environment, you steer your way around for the next few years. But on the other 50%, and Brett said 50-50 as well, I do think there's one other scenario here that I put lower probability here, and that's sort of a geopolitical risk event happens and the central banks just back off here, and we can't ignore all those things, but you can't get too worried about that, but it probably means that rate increases won't happen. and you actually say it's a 20 to 30% probability, and you probabilistically weight that, you actually say the risks are asymmetrical to the downside. You'd have to argue the probabilities are much different to 50-50. And if they're 50-50, there's much less on the upside than there is on the downside in these markets at the moment. And that's why we've got the most conservative position we've had for many, many years.
Okay, on that basis, you're the most bearish on the panel. So we're going to put you slightly.
I'm just probably the most realistic.
Yeah, no, we're going to put you slightly in the camp of a bear market, which, by the way, definition correction 10%, bear market 20% downside from where it peaked. So, Phil, we'll go back with you and we'll start focusing. We'll go down the funnel a little bit and get a bit more precise. So, survive. How do we survive when markets are wobbly? Because I think one thing that we might agree upon is the days of the extreme low volatility that you know has been around for the last 3 or 4 years, or since 2016, a couple of years, is probably over. What's your first instinctive move in that environment where it's going to be a bit more volatile?
Well, I feel like, you know, at Regal we're lucky. We're long-short investors, and, you know, with due respect to my long-only friends up here, I feel like they're kind of in the paddle without a canoe. They're going up and down with the tide and getting blown by the wind. Whereas if we're bearish, we can actually go short and make money from markets going down. So I think in this sort of environment, it very much suits a long-short investor. You know, we can make money on our shorts, we can make money on our longs. You know, the big thing that's changed in my mind is bond yields. It seems like bond yields were falling for 40 years, and now it looks like bond yields are rising. So that's a very different environment. You know, you go away from the bond proxies, you go away from the growth stocks, you go towards stocks that do well when inflation's rising. And so, you know, stocks perhaps like the mining companies, energy companies, you know, stocks that like inflation, stocks that can pass through price rises. And that's how we're kind of structuring our long portfolio at the moment. And we're shorting those tired growth stocks that are looking for the next, you know, leg of growth. We're shorting those expensive bond proxies.
Okay, thanks, Phil. Now, Stephen, you happen to be one of those guys in the canoe with no paddle. I'm just quoting a famous or a well-known fund manager here. But the smalls, to Phil's point, now we've had our first kind of crack in the whole bull market, and we've got the volatility. We were discussing earlier, the smalls and the growth stocks within the smalls, which have carried that sector, have hardly missed a beat in the last 2 months. So can you give us a bit of perspective about the way you see it forward, or are you surprised by that, or is that where you've got to stay because there is growth?
Yeah, I suppose from our perspective at Ophir, we don't mind a bit of volatility. It was actually sort of a little bit depressing last year with not a lot of volatility because it doesn't create as many opportunities for us. I suppose from an overarching perspective, if we just step back, well, what's causing the volatility? What's, a bit of uncertainty in that? But, in terms of the actual economic drivers for our companies, if our companies continue to do well, they continue to execute and they continue to grow, then, the volatility is effectively a subsequent point that shouldn't really affect what the underlying intrinsic value of our businesses are. So in terms of the way that we select stocks and what's important to us is that, so long as we could pick good businesses with good returns of capital run by capable management and have a good balance sheet that will always protect us on the downside, because that will always protect the equity value, and most importantly that we buy them at good to fair prices, then I think that will carry us through the volatility phase. Within that, one of the elements that I'd probably overarch on that is, from our perspective, if you're in a period of low volatility or in a slow grinding market that's going up, in terms of that scenario, you probably want to buy quickly and sell very slowly, because the market just keeps grinding higher and higher and you just don't know where that final value of that business could end up at. I suppose in a period of high volatility, which is what we're going through now at the moment, you probably want to do the opposite of that. You probably want to buy slowly, and the reason for that is, with the intraday movements, companies are down.
You get more than one chance.
Yeah, it was down 3% yesterday. It's up 5% today. So you want to sell quickly when they're up, but then you also want to be, and more importantly, have that ability and the firepower to deploy within your portfolio to get set in positions when the market does correct and there is no fundamental underlying change in your business. I mean, that's our core belief there.
Okay, let's just stick with you for 1 sec, because a lot of people in the audience would know the type of companies that you're investing. But what's the one thing, Phil's mentioned bonds. We had it in the previous conversation as the big burning issue where where bond yields go. What's your number one concern about your thesis that you just put forward about the way forward?
Yeah, going forward, it's ultimately going to be interest rates, which is going to drive it. And as Phil was talking about there, you know, with interest rates backing up, you want to be exposed to those companies that get a bit of free kick from the inflation. So therefore, it's not going to benefit the growth companies as much, but more the cyclical and the weaker businesses that, you know, in a low inflation environment couldn't pass on price increases because their businesses aren't as strong. So for us, you know, the way we're positioned currently at the moment is, yes, we agree with Phil being exposed to some of the more cyclical names there, but predominantly then still using that underlying process of picking good businesses, good balance sheets, and that can grow within that space. So for us, that's more in the mining services space rather than in the miners themselves. And within the other area, you know, we still like growth businesses and that, but we're obviously very conscious of valuation. So you don't want to be owning anything on extreme PEs or extreme EBITDAs or on extreme price to sales. And if you do, you've got to be absolutely confident that those numbers and those companies that they have to deliver. You know, the last reporting season that we just saw was a bit of the fallen angel scenario. We saw Domino's Pizza miss the numbers. You know, you might get a 5-10% miss, but then you get actually a 20-25% correction on the share price. BWX, you know, WiseTech, they're just some of the names. So, you know, growth is still fine, but you just got to be very diligent at this point in the cycle and making sure they deliver what they're going to say they're going to do.
Okay, let's get on the plane, Hamish, and go offshore. Obviously, the US market in particular has led the charge since 09, up, I think, from top to bottom from March 09 till now, about 300% just in price terms, let alone dividends. Led by the tech sector and the FANGs, which you've done particularly well out of over many years now and continue to do well out of. What can you do besides raise your cash levels as a long-only fund to, you know, around that mid-teens? Where are you going to hide to make sure when we talk about surviving, especially if your bear case pans out, which you've outlined both sides of what could happen?
Yeah, I must say the bear case doesn't really worry me at all. And, you know, Phil says we're in canoe. I have to say at Magellan we feel like we're in a fully armed aircraft carrier. So we run a strategy with inherently a lot less risk than markets. We're not long short, but we run it to a whole lot of metrics around drawdown risk and volatility risk. We cap that out, and what we do during parts late in the cycle, we then take that risk down substantially less than the market risk without shorting, but we do a whole lot of other things to take that risk down. And if you look over our 10 years, we've participated in any 3-month period where the markets have gone up, we've participated at a rate at 100% of the upside, and any period where the market's gone down, we've participated at half the downside in markets. So yeah, we'll see a bit of downside in markets, but because we're long only, so we won't go up when the market goes down. But am I losing sleep over a big correction? I go come and bring it on at the end of the day, because that creates the best opportunities for us. We should get it. We've got a lot of cash at the moment. We should have a big advantage going into some volatility. And anyone who's got a reasonable time period here, it's very difficult to call the thing of exactly when you sell and when you sell out. We're taking a position over the next 12 months to run less risk. And when it happens, we've tended to do very, very well when those markets, it's no guarantee, but that's not the scenario I lose a lot of sleep over. So we're probably running, as I said, the most conservative position we've run since 2008 now in the strategy. I completely agree that you want to run in sort of all scenarios other than a North Korean war or something, probably underweight low volatility assets here at the bond yield proxy stories. I think we seem to be agreed on that topic. But I do think you need to look at the world, and the world is changing on us. And we kind of split the world into two areas, and we can talk about the technology platform companies. But at the end of the day, there are some fundamental businesses whose, because of the platform economics, they're winning in a big way, and some of them are still very early on in the ultimate market shares. It's a regulatory risk somebody refers to, which is the big issue there. On the other side of that, in the traditional world, you really have to focus on businesses that are very unlikely to get affected by a lot of this platform and other technology risk that's going to be evolving over the next 5 to 10 years. It's already starting, but I don't think we've really seen anything yet. And businesses you may have thought were safe in the past may well not turn out to be safe in in the future. So as we're going through this cycle, there's a short-term issue about the next 12 or 18 months and what happens to bond rates, but there is a much bigger long-term issue about where you want to be positioned. And I think you have to be thinking over this sort of 12-month cycle, and you have to be thinking out 5 to 10 years, and not just reverse into something that worked for you in the past.
Okay, just a good point there, and everyone knows about this, and we've grown to know them. The FANGs, which Magellan's had a great exposure to. In recent times, Facebook has hit an air pocket in its development, something that I would have thought most people were aware of, that they were giving up personal information, and it may have been used, but it seems like all of a sudden it's got a lot of traction with the Cambridge Analytica situation. So do those kind of things worry you, or is that just something that those big, strong tech companies will adjust to and move forward? How do you see that?
Well, Matthew, you really need to break the regulatory risk for a company like Facebook into 3 different areas. The first is what I would call privacy and data sharing, and that's what Cambridge Analytica was all about, where really what happened, you had a third party who could effectively use the Facebook platform to upload their own app. And in order to get any information on that app, the person who uploaded the app had to opt in to actually, they wanted to share their information. But what really happened, that was only 270,000 people, but once they opt in, effectively all their friends' information got shared also, which took the sort of 270,000 people to 50 million people. Are we worried about that particular issue? The theoretical worry is that Facebook in 2011 entered into an agreement with the FTC, the Federal Trade Commission, and under the consent decree that they'd entered into, any breach of that consent decree, they could face fines of $40,000 per user. And you don't need much mathematics to work out 40,000 times 50 million is 2 trillion. To work out the fine could be relatively large. Google did breach an FTC consent decree, and they got a fine of I think $22.5 million. The largest regulatory fine that's been handed out is 2.7 billion euros. 2.7 billion euros would kind of tickle them up with a feather duster. A very important issue here, and I'm coming to the privacy issue, is the consent decree actually strictly permitted that if you got the original user's consent, Facebook was able to share all the friends' information with no other consent. So that was actually permitted by the FTC in the consent decree. So I think it's very unlikely they're going to end up with some massive fine out of this, and a $2 billion fine wouldn't worry us. You know, it's wiped off 60+ billion of market cap for maybe a fine of $2 billion. What this is really going to bring on is a greater focus around the privacy and data sharing issue. I think Europe has a very good example under their general data rules that are coming in May. I think we're going to get a lot more opt-in with that. Ultimately, I think that type of sharing of friends' information is going to stop. The good thing about Facebook ultimately, and why we're not that worried, is Facebook actually does not need to share the personal data with any third parties. It did it in that particular case with the apps, but for their advertising platform, they do not have to tell the advertiser anything at all about the ultimate user. They can target the ads into your news feed for the advertisers without sharing any of that information out of their ecosystem. So tying down the privacy and data rules, I don't think and ultimately is going to impede this incredibly powerful advertising model, the likes of which the world has never seen before. There are 2 other regulatory issues, sorry, I'm coming to it, and people are focused on this one and it's not the major issue. The biggest issue is, I would call, is weaponising the platform. So this was the Russian issue that
so we're back to your battleship now.
Yeah. So weaponising the platform. That's one that's causing us a lot more angst than actually the current share price, the 12% share price reaction. We think Facebook is ridiculously undervalued even before the correction. If you look at weaponising the platform, it's far more complex. There's 2 parts of it. First of all of them, accepting paid advertisements in rubles on their platform for Russian ads. Facebook should have never done that and should deserve the fines that they may get for doing that. And it's very easy to shut off that type of thing, either ban political advertising altogether or put the same thing you have on television, that the advertiser has to be disclosed, everything has to be disclosed as a political ad. You know if it's a political ad, and therefore you would have to get the information, disclose it. The problem that went further than this is if you look what the Russians did, and it was unbelievable if you read the Mueller indictment of the 13 nationals that got released in February. What actually happened here is the Russians stole identities of Americans, opened up bank accounts with those stolen identities, and then with those stolen identities started making posts as if they were real Americans, because they were real people, they'd just stolen their identities, and they put posts into people's news feeds and got themselves signed up in different groups, knowing what their interests were. And effectively they would do things like they would get a photograph of an immigrant standing in a crowd with a sign around them, and they would doctor the sign and put "I love welfare" on it, and then post that onto Facebook. So fake posts or fake news. They weren't paid. Facebook wasn't getting any money for this. That is a really complex issue. So how do you stop foreign actors with espionage impersonating other people to put feeds into something like a news feed? I think this can only happen with the full cooperation of the security agencies, the regulators, and a platform like Facebook. The risk in Facebook is a nuclear option, that the regulators then throw their hands up and say it's completely Facebook's problem. If there's ever a fake post on your platform, you're fully liable for it, which they're not at the moment because they're not publishers. But they make them fully liable. That would effectively shut the platform down.
Yeah.
We think the risk of the nuclear option of what we're hearing out of Washington is a very, very low risk. The Republicans have no appetite for that.
So just there, I'm going to have to pull you up because we've got to get back to the ability to prosper. So that will come into that because you've talked about Facebook.
Buy Facebook at the bottom.
but you'll get an opportunity of that in a minute. So we've got the backdrop. We're going down the funnel. Now we're getting into stock selection. We've survived. We're on a bumpy road, but we've survived. Now all the audience want to know how we prosper. Phil, some names that you've given us, the sectors, what you like. What are the kind of names that are exciting you that will help us prosper in this heightened volatility, correction / possibly bear market?
Well, the first one that springs to mind actually is Tencent, because if you like Facebook, I think you must like Tencent. So Tencent's got a billion Chinese users. I think Facebook's got 1.5 billion or something.
It's got slightly more users.
Yeah, okay. But the beauty about Tencent is the users spend 4 hours a day using the app, whereas Facebook users probably spend on average an hour a day. And then Tencent it's the Uber. It's got gaming opportunities. It's got food delivery. It's got financial apps, and so it just encompasses someone's life a lot more. And so there's huge more opportunities to leverage off that in the future. So we like Tencent. We're focused on Asia, so that's probably our top pick in the Asian region.
And that's purely based on its ability to continue to grow,
correct,
no matter what the economic cycle is.
Yeah, and I think that's something that you have to look for at the moment, something that's not too leveraged to interest rates, not too leveraged to the economic cycle, but is got kind of structural growth.
And just on that, Hamish has outlined the risk around regulation, from not much to a nuclear option. Tencent, how do they fit into that, do you think? Does that worry about what you pay for it?
Well, as long as you stay friends with the Chinese government, I think you're going to be in a good spot. And so I think their biggest risk is managing that relationship with the Chinese government. And if you're friends with the Chinese government, and it might not be great from a human rights perspective or whatever, but I think from an investment perspective they'll do well. Okay,
are you prepared to go the other way and reveal a short, or is that too poisonous in a public arena? We're not going to force you on it.
Look, if we've got the Asian theme, we're short a stock in Korea, $40 billion, Celltrion. We think it's a bubble stock. Some people call it the Bitcoin of Korea. And it listed last year, and I think it's up 10 times since then, $40 billion. In our view, worth close to zero, no valuation support. It's had an incredible run. The Korean stock market has a lot of retail investors punting it. In January, the stock received a letter from the FDA saying your manufacturing facilities aren't acceptable for producing drugs. if that was received by a stock listed in the US, it would have been down probably 30, 40, 50% or something like that. But the Koreans ignored it. So yeah, we're short Celltrion, and we think there's still 100% downside, even though it's fallen a long way.
Just one more quick one. Your short book, is it bigger than what it was, say, 6, 12 months ago? Just to get a bit more of a feel on how you're handling the situation at the moment.
Yeah, look, I think that's fair to say. We're finding more opportunities to short at the moment. There's shorts on valuation grounds. Higher bond yields make certain stocks more expensive, we think. And there's shorts, I think the biggest challenge for the Australian market is not so much valuation, but it's what I call earnings. And there's simply not much earnings growth at the large cap end of the Australian market. Whether you're looking at the banks or the supermarkets or Telstra, there's very little earnings growth. And so that's the biggest challenge for the Aussie market. And so, that's fine if you're on a, like the banks maybe on a PE of 10 or 11 or 12 times. But I think for some of these kind of growth stocks that perhaps still trade on 30 times, I think that's a challenge.
Mm-hmm. Stephen?
Yeah, maybe I'll...
Let's go with the stocks where we're going to prosper.
Maybe I'll go on the exact opposite end of where Hamish and Phil have gone, and give you an old-fashioned retailer that's not been disrupted by the Amazons, the Googles, the Facebooks, and it doesn't have any AI or anything like that. But for us, a stock that we're very excited about is Premier Investments. That they own the Smiggle brands, and if any of you have young daughters or kids between 7 and 12, probably pains you to pay for a $20, $30 briefcase, or a $60 a backpack, or a $20 water bottle. But we sort of think it a bit like Warren Buffett, when he talks about See's Candy, when no husband, boyfriend or that ever got in trouble coming back with See's Candy. And it's a bit like Smiggles, no kid ever goes to school boasting about a pencil case from Big W, Coles or Officeworks. But the real bit that excites us is, it's a management team that has doubled profits over the last 4 years. It's done it all organically. It hasn't issued any capital as part of that process. But between Smiggles, which we believe is a truly global brand, there's no disadvantages of running that business and owning it out of Australia. You don't suffer from being in the Southern Hemisphere and having the differences within the apparel seasons that you have here. That business, and Peter Alexander, we now believe are over 75% of group earnings from 44% 5 years ago.
Do you think they'll ever spin them out so you can pay a bigger multiple?
I think ultimately over time you won't need to, but it's probably beneficial, because just over time, just as they were 40% of earnings 4 years ago, they're 75%. As you continue to grow, look, they're in the UK, they're in Asia, they've just gone into Ireland, they're going into the continental Europe. The growth options are numerous. They can go to the US, they can go to China, they can go to Japan. It really is a global brand, and so whilst it's 75% now, it's going to be 80, it's going to be 85%. The market will recognise that growth. It will pay for that growth going forward. And the one additional element that we really love about this business, and where it is benefiting from the advent of online, is that the rough rules of thumb in Australia is as a retailer you typically needed to own 100 stores. In the UK you typically needed to own 200 stores as a specialty retailer. With the advent of online, that becomes your number one store. You might only need 150 stores now.
It's the brand that matters.
The capital intensity is decreasing, the cost of growth is becoming lower, and what's the great thing about it is you're going to find out where your next country is going to be rolled out in. They rolled out into Ireland because that was their biggest country after that was buying.
Okay, I can see James getting a sore back looking at picking up that bell.
Go around one more round and then we'll get the questions.
Yeah, okay, all right. So Hamish, you've outlined Facebook. Have you got maybe something else that you think is, and you talked about not only the next couple of years, but a 5 or 6 year disrupting world economy with certain companies? Can you give us one that might power through any kind of market scenario and continue to grow?
Yeah, I'll give you two in that scenario. Obviously, we're very big on the big tech platforms. I don't disagree with Tencent. I have a slightly different take on that, but it's a fabulous business as well. I'll give you two other names, and I don't do this often, so no one write anything down. This is just inside the club. One business that I think is, if you took a 5 to 10 year view, I think Kraft Heinz, and that would be something that you'd say, why on earth would you buy that? Kraft Heinz is now controlled by 3G, which are the Brazilian private equity firms. The founder George Paolo Lehman is the 15th richest guy in the world. He's partnered now with Warren Buffett. The company's now more than at a 52-week low, but almost going to multiple year. Now, because it hasn't done a deal, they bid for Unilever early in the year. If you look at their track record, what they did in the beer industry, they started with a small Brazilian brewer. They went and then they bought a bunch of breweries in Europe. Then they bought Anheuser-Busch, then they bought Corona, and then they bought SAB Miller. And ultimately they'll buy Coke or Pepsi. So starting with one little platform and the amount of value that they created by doing that. These are by far and away the longest term thinking, best private equity players the world, I think, has ever seen. Now you're partnering up with the same guys at the start of the roll-up of the whole, what I'd call the food, staple complex and household and personal care products. They will look everywhere to roll up the entire industry. You have got maybe 10 to 20 years ahead of a partnership with 3G at the lowest price it's been in for a very long period of time. You can't pick when the deals happen. You have to wait for the stars to align, and therefore the stock price could be a little bit volatile until people wait for the deals. And the fees you pay the best private equity operators in the world are zero. They do not charge the fund or the company any fees. They're partners. They own 26% of the company. The partners of 3G in their side, and Buffett owns 26% of the company, and you can sit in there. So if you want to take a long-term view and watch to happen in Kraft Heinz that happened in the beer industry and all the money and value that was created by them, I think that's a very interesting pricing. Now, effectively, you're paying for Kraft Heinz probably less than just what Kraft Heinz is worth for the old businesses of Kraft Heinz there. The other one, if you want to take a long-term view, is we've taken a position in Starbucks. At the moment, Starbucks has come off materially. I don't think Starbucks is about to be disrupted unless we're uploaded to computers and don't drink coffee anymore. I don't think those habits are about to change in the next 20 years. The big part of Starbucks that's really interesting is their China business. That business is been there for they've developed over 20 years, by far and away the largest coffee business in China, 3,000 stores. Over the next decade or so, that will probably roll out to 20,000 stores in China. The economics are mouth-watering. Their business in the US is a fabulous business, slowed down a little bit at the moment, but still a lot of sales layers in food to get there. And then they own their own coffee brand that is now becoming the largest coffee brand in supermarkets. People may not like Starbucks coffee. You have to have an American taste to have their drip-filtered coffee. But it has got a long, particularly out of China, has got a very long runway for growth. And because of the nature of the economics of the business, with very attractive economics, to us it feels like Yum Brand's business in China about a decade ago. And we invested in that a decade ago, and have probably made our investors 10 times their money over that time. So let's see what happens over the next decade.
So there's an eclectic bunch, probably what we wouldn't have expected.
Thanks, guys. So most people watching the Royal Commission have been surprised how bad it is.
And this is the banking.
The banking. Yeah. Is there any other space? And you know, when they first started 2 weeks ago on the first day, for example, CBA was at $77 something. It's now $72 something. And yet we're talking here about 30% of the ASX 200. So my question is, that's going to unfold for the rest of the year, and it's just going to be a train wreck. Can, in that scenario, large caps outperform small caps for Australia, and can the ASX 200 outperform international markets with that scenario unfolding?
Who wants to take that one? Phil, are you?
It's going to be tough. Yeah, it's going to be tough. It's not great for the banks. It's obviously they've been doing some horrible things, and I don't think they'll ever regain their glory again. So we've seen a big de-rating. It's probably deserved, but there's a bit in the price, and so whether small caps can outperform, look, that's a beta call in some ways. I think the beta on the small cap sector is a lot higher now than the large cap sector, and so if the market goes up, I think the small caps will outperform strongly. But yeah, look, the banks, they're not going broke. The balance sheets are in better shape than they've probably ever been for a long time. Loan losses remain low. So, there's not, I don't think you want to get too negative on the banks at the same time.
Okay, next question. Anyone? Lady up there?
So normally towards the late stage of a cycle, you see a commodity ramp up. In other words, you see when you go through historically looking back 40 or 50 years of economic cycles, in the last couple of years, commodity prices normally have this real ramp up. So are you seeing value in this segment? Would you argue that we're going to see this again? If so, how are you positioned?
Who wants to take that one? Stephen, you?
Yeah, I sort of just broadly, I mean, obviously we had that super cycle from 2002, to 2008, bit of a pause, and that continued to 2013. Obviously then had the downdraft for the last 4 years, and typically resource cycle 4 to 5 years on the way up, 4 to 5 years on the way down. So therefore, we're sort of positively predisposed to that just from a cyclical perspective. When you look at that on the overarching companies themselves, a lot of the spend, especially out of the iron ore and the coal guys, is just to maintain production, let alone grow production within that space. So therefore, whilst we don't have a firm view in terms of the actual resource prices themselves, albeit probably, as Phil said, probably predisposed based on the fact that inflation is picking up and global growth is accelerating. It's more on the fact that, with those miners needing to spend, we want to be exposed to some of that spend that flows through, and the business that can be exposed within that area generally have significant leverage that we saw back in the last cycle, back in 05 to 08. So, the McMahons, the Monadelphous and that, those businesses can grow and accelerate very quickly because they don't require a lot of capital. They're generally people-based businesses within that areas, and the contracts that can be issued can be quite large and chunky and over multiple years. So therefore, we wouldn't play specifically the resource names. We're a bit more, back in the gold rush by the guys selling the pick and shovels rather than the gold itself.
Hamish, looking globally, have you got a view on commodities at this time in the cycle? Because traditionally
we don't invest in any commodity stocks. There's very few commodity companies through the full cycle who add much value. There's a lot easier ways of getting rich than playing the commodity stocks. I think you have to be a trader at the end of the day to do it. Play them the full cycle, and it's probably going to be a good recipe to having moderate wealth over.
Okay, I'm not going to accuse Phil of being a trader, but you look like you've got a view.
Yeah, well, I think for the last 40 years, inflation's been falling, trending down, and so obviously that's a period that mining stocks tend to underperform. The big exception was the emergence of China in around 2000 that impacted commodity prices and had, as Stephen said, what some called the stronger forever cycle, which didn't exactly last forever. And then we had a pretty savage downturn. And so that's part of the reason we like mining stocks at the moment, is that we think there's a really solid base. The underspend on CapEx has been quite significant over recent years. And so, looking forward, I think there can be a case where, this cycle could have legs. And so we like the leverage plays on the mining sector, like the mining service stocks. And we also like some of the, the commodities that are exposed to themes like electric vehicles. So, one of the stocks, for example, that we like at the moment, there's a lot of hype in lithium stocks and things like that, but a stock that we think's off the radar is Lynas Corporation, the largest producer of rare earths outside of China. Was a market darling 7 years ago. It really got savage because it took longer to get into production. Rare earth prices collapsed, but now, the production facility in Malaysia is working well, the mine's up and running, the balance sheet's repaired, and rare earth prices are going up, driven largely by electric vehicles. And yet, at the same time, there's no major Australian bank or broker that covers the stock, and it's almost $2 billion. So, that's one stock that we actually like in the mining cycle.
All right. Any more questions? Oh, we've got a few now. Coming with a rush.
We've touched a little bit on regulation, particularly in the tech sector, Hamish. Do you think, I guess, that this is a super cycle of over-regulation in some of these big fangs? Is this just the start of, as they enter financial services, could they potentially become as regulated as some of the banks?
It's the big question whether or not they could turn these technology companies in some form of utilities. I'm not sure breaking them up, separating YouTube from cloud from search in Google is actually going to destroy a lot of value, and I'm not sure the regulators would really be doing other than forming into three very large companies and maybe ultimately autonomous vehicles or something. So breaking them down their natural lines, I'm not sure is going to give us a lot of nervousness from a shareholder's point of view. Could they take regulations that fundamentally go to the whole business model, where effectively they have to turn around and they have to pay the users for their data or something? I think that is a draconian measure to be taken in a capitalist democratic society. I think there's nearly no chance of that happening in America. I think where the Europeans are going, it's much more around privacy and taxation side of it. Those type of things are easy to model and understand where those regulations are going. The break-up risk is a risk, but I don't see it probably destroying a lot of value. With some of them, it may even unlock some value, because there are some very large businesses within Facebook or within Google that are probably not being valued, and they'd probably be valued very highly if they were separate companies. And these companies would be $100 billion companies or something. They're not going to be small if they're...
Spin-outs are pretty well part of a normal cycle in any maturing business. But
for spin-out by regulators, you know, that's happened before when Standard Oil and things was broken up. It was touted that Microsoft would be broken up, and it wasn't. They tend to have behavioural undertakings put on them and some fines. But if you look at the Google fine that it had fairly recently of its vertical shopping, and I think we're going to get a few of those other determinations out of Europe, the fine was 2.7 billion euros, I think. It was like, as I said before, tickling them up with a feather duster. I call it post-paid marketing. That once you've actually got all the customers and put all your competition out of business, you then have to pay some marketing costs after.
Cost of doing business.
After the event. These business models are truly extraordinary, and I think it's hard for the regulators. I think you're starting to see the regulators having to say is, how does a regulatory environment now fit in here? And most of the regulatory environment around consumer protection, these are perverse business models, because most of their services to the end consumer are given away for nothing other than the provision of data. And there's an asymmetry about the value of that data. We as individuals value the data less than the recipients, being the companies who can monetise it with the advertisers here. And under the general data rules, they could be forced if people don't want to opt in to the provision of their personal data. Now they're able to... Previously, they just didn't provide their service. If you didn't tick the I agree button, you didn't get any further. So it effectively forced everyone to tick the consent. Now the Europeans are forcing them that you have to opt in to get the service. Facebook, if you don't opt in, I think, or Google, they will ultimately, they're permitted to charge people for the service like $3.99 a month. I guarantee once they're told to pay, if you don't want to opt in but you still want the service without providing data, it's going to cost you $3.99 a month. I bet 99.99% of the people tick the box that says I don't want to pay. There'll be a few people who protest and don't use the services at all. But I suspect most people are, if you get to the heart of it, provided there's better rules around it, that people aren't going to do really perverse and handle your data to third parties, which I think those rules are going to come all around the world. Once those rules are in place, I suspect this won't be as big a regulatory concern as it may appear just at the moment. But regulation's going to keep coming in different forms as these business models keep evolving.
Have we got time for one more, James? There's a lady down the front. Yep.
Thank you. I've been binge watching Black Mirror lately, and it made me think about Hamish's keynote last year at the Livewire Live, where you were talking about, you know, the guy walking down the corridor and his new job, or well, the boss.
That was the video I did.
It was the video, yeah. So, and you spoke about things like hologrammatic change rooms and self-driving cars, and some of these themes have come up again today. Outside of what you've spoken about, what are perhaps the top 2 or 3 product trends related to the tech space that you think are going to come through outside of what you spoke about last year?
Yeah, I can't recall exactly what I'm talking about. I think some of the big product changes that are going to come is ultimately voice as a platform. We're starting to see that in fairly rudimentary forms with the Alexa by Amazon and obviously Google Home, and now you've got the HomePod, which is powered by Siri by Apple. I think the whole concept is voice as a platform and what that does and how it intermediates brands and disintermediates brands. I think that's a new trend that's coming. I think also advanced forms of robotics in terms of autonomy. Obviously, we've got drones that are flying around. I think we are going to get autonomous vehicles. If you took a 5 to 10 year view, I think it will first come in the car sharing or the car hailing sort of mode. I think it'll be too expensive initially for everyone to have their own autonomous vehicle. But I think that whole thing of a lot more sort of robotics in society closer to, there's robotics in factories, but robotics in our life, in services. And then if I took a longer term view, I think it's going to be really machine learning and artificial intelligence getting into the service industries. We've kind of automated the blue collar worker, but we haven't automated the white collar workers of society. And ultimately it's machine learning and AI that's going to enable the automation of many of the white collar jobs. And I think that's the biggest issue for society to come to grips with. What happens is when we took blue collar works out of society, we went and educated ourselves, and through education we found higher values, and the people who couldn't get educated, they've been left behind, and that's part of the political issue. But what happens when technology does not distinguish between the colour of your collar? And then how are we going to deal with that issue? And I think we're within 10 years of that becoming a fundamental shift here, and you could think across industry and industry and industry once you can get into that area. The funds management, ultimately, yeah. Maybe we'll just all be in virtual reality pretending we're funds managers.
Right. Thank you, Hamish.
Is that it? We're done?
Is there anyone else?
Because we'll get these one more, and then we'll get the gentleman to tell us where the markets will be at the end of the year.
So you were talking about Facebook and Tencent before. Now, Tencent integrates a lot of different systems that currently Facebook uses other people to have, and that's due to a lack of an English-based version of Tencent. If Tencent were to release an English-based version, which they've started by opening an office in Australia, would that not see the death of companies like Facebook that fail to adapt and integrate these services?
No, it is very difficult to get the network effects in these businesses, and there are a huge number of examples of second players coming into home markets to try and get market share. You know, Amazon's tried to go into China, eBay's tried to go into China. You know, to compete against the businesses who have got that incumbent advantage, it's very, very difficult to compete. So am I worried about Tencent coming in with their social platform into Australia or America or Europe and getting a material amount of market share? I think it is really, really hard. Just like if China was opened up, I think it's going to be really, really hard for a Facebook or a Google to take on a Baidu or Tencent. I think once you've got that complete incumbency of got all the users and all the services, it's just really, really hard to break that down. So therefore, I think both of them are quite protected in their own world. Certainly for the Chinese consumer going around the world, the payment services that you got through Tencent and Alibaba, those payment services are going to be spreading around the world. But I don't think that necessarily means all Australians will start using Alipay. But I think most Chinese travellers would be using either Tencent or Alipay in their systems.
I tend to agree, yeah.
Okay. Can we...
Great.
Yeah?
We'll wrap it up there. Do you want to...
Yeah, no, Stephen, you can do the small ordinaries index, given that's your playground.
I'll say
how much up over the year, or down, or round, or...?
On average, market always looks 8 to 10 in that space. I'll pick 10. 10 for the...
Phil, you can do the 200 in Australia?
Yeah, up 5%. You know, not much earnings growth, but I think there's a bit too much pessimism around at the moment.
Okay. And Hamish, do you want to do the US market, the S&P 500?
I'll confidently predict it'll be up or it'll be down. I've got no idea.
By what percentage up and down?
I haven't got the faintest idea, to be honest.
Okay.
All right. Well, I think with that we'll call that neutral. Ladies and gentlemen, could you please put your hand together for our panel?